Welcome back to the Noob Selling Options channel, everyone. I am absolutely thrilled to have you here today. In this explainer, we're going to do a deep dive into our very next strategic options play. We are talking all about defending the $86 strike. If you've been following along with our recent trades, you know that options selling is really a game of strategy, patience, and logic. So let's dive right in and see exactly how our recent successes have set the perfect stage for a highly calculated, totally new entry.
Here is our roadmap for today. First, a quick welcome. Second, we're reviewing our $89 covered call win. Third, churning the options wheel. Fourth, we're defending our new 86 strike. And finally, we'll wrap up with your next strategic move for execution.
All right, part one. Welcome to Noob Selling Options, building a high-conviction fortress.
Now, for those of you who are new here, and honestly, just as a quick reminder for our channel veterans, our main goal is systematically compounding capital to build a long-term tech fortress. And looking back at our last trade, man, I couldn't be happier. As the source material literally puts it, that is textbook execution. Because, when you follow a disciplined mechanical approach, the market actually rewards you.
Moving to part two, the $89 covered call win, securing the upside.
Having our shares called away at $89 was the absolute textbook assignment we were aiming for. It was a huge win that effectively paved the way for the new, even better entry we're executing next. But what does this actually mean for our portfolio in practical, everyday terms?
Well, by exiting at 89, we didn't just get one payoff, we got two. First, we successfully captured the premium from selling the covered call right from the jump. Plus, we locked in the capital appreciation of the underlying stock all the way up to that 89 strike price. We secured the profits on the upside exactly as planned. But listen, we don't just stop there and sit on a pile of cash. No way. We put that capital right back to work.
Which brings us to part three, churning the options wheel, the continuous cycle.
Now, we all know the mechanics of the wheel, right? That systematic, disciplined rotation of selling cash-secured puts and covered calls to secure our profits, manage the downside, and generate income. So right now, we are churning that exact wheel by pivoting directly into selling an $86 cash-secured put on the exact same asset now.
And think about that. That is exactly $3 less. We are essentially setting up a trade to buy back the exact same high-conviction tech asset at a solid discount from where we just sold it. And the best part, the kicker here is we're getting paid a premium just to sit around and wait for it to drop to that price. We sold at 89, and now we're offering to buy it back at 86, pocketing cash in the meantime. It is just an incredibly efficient way to trade.
Let's get into part four, defending the $86 strike, the four pillars of the trade.
So here is our target, $86 for the upcoming Friday, May 8th expiration. And I want to be clear, this isn't just some random number we pulled out of thin air. It's a highly strategic entry point for a cash-secured put. To really understand why this is the strategic solution we're looking for, we've got to look at the structural foundation sitting right beneath this specific price point.
There are four completely logical pillars that justify the 86 strike. First, it gives us a buffer below immediate support. Second, it capitalizes on elevated market volatility. Third, it offers a really attractive cost basis. And fourth, it sits in very close proximity to a major psychological floor. Let's break down each of these pillars one by one.
All right, pillar number one, a buffer below immediate support. Just last Friday, NL saw an intraday low of $87.87 before it bounced back to close much higher at $91.16. By selecting the $86 strike, we're placing our contracts safely below that immediate $87.87 support zone. Why does that matter to us? Well, if the broader market experiences a midweek dip and NO tests that 87 level again, our $86 strike acts as an extra layer of structural defense. It lets us keep the premium without taking assignment, even if the stock takes a temporary tumble.
Pillar number two, capitalizing on elevated volatility. Right now, implied volatility is remaining very high. This is mostly due to the recent tech sector pullback and now zone post-earnings drop. When IV is elevated, options premiums are much richer than usual. Because of this, we can step roughly 5.5% out of the money, all the way down to that $86 mark, and still collect a really meaningful weekly credit. This rich premium effectively lowers our break-even cost down into the mid-85 range, so we're getting well compensated for the risk.
Moving to pillar number three, an attractive cost basis for the wheel. Remember, properly executing the wheel strategy means you need to be totally comfortable owning the underlying asset.
For an investor trying to build a portfolio fortified by enterprise tech leaders, acquiring NOW at a net cost basis of around $85 to $86 is fantastic. That's the equivalent of about $425 to $430 before the recent 5-for-1 stock split, which is a steep discount from its historical valuation. And hey, if we do get assigned at 86, it positions us perfectly to just start selling covered calls right on the rebound.
And finally, pillar number 4, proximity to the psychological floor. Look, if market selling pressure aggressively resumes, 8500 acts as a major, round number psychological support level. By placing our strike at 86, we are standing right at the gateway of that floor. This strategic placement makes sure we aren't catching a falling knife too early if the stock decides to drift all the way back toward its 52-week low of 81.24. We are shielded by that $85 floor right beneath us. Now, of course, keep in mind, options trading involves risk, and market conditions shift rapidly, so this explainer is strictly for informational purposes, not financial advice. But structurally speaking, the logic here is incredibly sound.
Let's wrap it up with part 5, your next strategic move, execution timing. So how should you actively manage the capital freed up from that massive $89 win? Here is the first real strategic choice you need to make regarding your portfolio allocation. Are you planning to deploy the capital freed up from those called-away shares entirely into this NOW cash-secured put? Or are you keeping some of that powder dry to write puts on other semiconductor or tech plays that might pop up later this week? There's absolutely no single right answer here. It completely depends on your overall portfolio concentration and your personal conviction in the broader tech sector right now.
And that leads us to the final, critical timing question I want to leave you guys with. Are you planning to wait for a red day early in the week to open this $86 put position and really maximize the premium when volatility spikes? Or are you looking to execute right at the Monday open to lock it in and let the time decay start immediately? Think critically about this, because your entry timing can significantly impact the total credit you end up collecting.
I would love to hear your game plan in the comments below. If you found this breakdown of the $86 strike helpful and you want to keep learning how to build that high-conviction tech fortress right alongside us, please make sure to like this explainer and subscribe to the Noob Selling Options channel. We're going to keep churning the wheel, locking in those premiums, and systematically compounding our capital together week after week. Thanks so much for joining me, and I'll catch you in the next one.